Hey there traders, welcome to RET Gamma, your go-to source for cutting-edge market insights. I'm your host, and today we're diving into a game-changer for your trading strategy understanding positive and negative gamma regimes. We'll break down what these regimes mean, how they impact your trades, and how you can spot them using RT Gamma's pre-open gamma data. Let's get started. First, let's define gamma regimes. Gamma measures how much an option's delta changes with a $1 move in the underlying asset, like the SPX. When we talk about gamma regimes, we're looking at the total gamma exposure, or GX, of the market, which tells us whether market makers are net long or short gamma. This is where positive and negative gamma come into play. A positive gamma regime happens when market makers are net long gamma. This means they're buying into market dips and selling into rallies to hedge their positions, which acts like a shock absorber for price movements. In a positive gamma environment, volatility tends to be dampened, and price action is more stable. Think of it as a market with guardrails. You'll often see smoother trends or range-bound trading, making it a great setup for strategies like trend following or selling volatility. On the flip side, a negative gamma regime occurs when market makers are net short gamma. Here, they're forced to sell into declines and buy into rallies, which amplifies price swings. This creates a feedback loop that can lead to sharp, volatile moves, sometimes called gamma squeezes. In a negative gamma environment, expect choppy action or big breakouts, which can be a goldmine for directional trades but risky for range-bound strategies. So how do these regimes apply to your trading? Let's break it down. In a positive gamma regime, the market's stability can be your friend. You might look for opportunities to buy dips or sell calls against a rally, knowing that MMs are likely to keep prices in check. But in a negative gamma regime, volatility is your ally, or your enemy, depending on your setup. You'll want to be ready for big moves, either by playing breakouts with directional options, or using straddles to capture volatility. The key is knowing which regime you're in, so you can adjust your strategy accordingly. Now let's see how you can identify these regimes using RT Gamma's pre-open gamma information. Take a look at this example from March 28, 2025 for SPX. This is our All OPEX Gamma by Strikes report, and it's packed with insights to help you trade smarter. The first thing to check is the total gamma exposure, or GEX, right here at the top. On March 28, SPX's gamma exposure is negative 19.2 billion, with put gamma at negative 16.3 and call gamma at 2.9. Since the gamma exposure is negative, we're in a negative gamma regime. This tells us that market makers are net short gamma, so we should expect amplified price swings. Volatility is on the table. Next, look at the gamma profile to see where the action is. The largest gamma concentrations are at 5,675, 5,565, and 5,600. With SPX at 5674.7, we're right near the largest gamma concentration at 5,675, which acts like a magnet for price action. In a negative gamma regime, a break above 5,675 or below 5,665 could lead to a sharp move as market makers hedge their positions, selling into weakness or buying into strength. To dig deeper, check the real-time open interest chart. At 5,675, we see heavy call open interest buys and put open interest buys, creating a battleground. This balance, combined with negative gamma, means market makers will amplify any move away from 5,675, up or down. If SPX breaks above 5,675, expect a potential short squeeze as market makers buy to cover. If it drops below 5,665, we could see accelerated selling toward 5,600 or 5,565. So, how do you use this in your trading? In this negative gamma regime, you'll want to be ready for volatility. A straddle at 5,675 could capture a big move in either direction, or you might play a directional break, buying calls if SPX breaks above 5,675 or puts if it falls below 5,665. The key is to use RT Gamma's pre-open data to spot the regime, identify key levels, and position yourself for the market's next move. That's a wrap on positive and negative gamma regimes. With RT Gamma's pre-open gamma data, you can identify these regimes, understand their impact, and trade with confidence. Ready to take your trading to the next level? Sign up for RT Gamma today and get the edge you need to navigate the markets. Don't forget to like, subscribe, and hit that notification bell for more insights. See you in the next video.